Hey folks, welcome back to Real Estate Investing Unmasked. Today, we're going to talk about velocity banking. I had a viewer reach out to me via comment below in one of my videos, and he asked me, his name is Denzel, Denzel asked me to go take a look at one of his videos where he preaches velocity banking. And I say preach because, well, the guy is a man of the heart. He's a very good man. His aim is to help people get out of debt as fast as possible and to change their life around for the better. And for that, I say God bless you. He asked me to do a review on his video and tell him what I thought about his methods for velocity banking. And so I wanted to go, and he's not the first one who's asked me about my opinion on velocity banking. Now, you may have heard it called a couple other things. You may have heard a debt weapon, using a debt weapon, or using a line of credit to help pay off your mortgage faster. The fact of the matter is, whenever you borrow money to pay another debt, you're just increasing how much debt you have. You're also increasing your risk. Having said that, I had to create an Excel spreadsheet that would take his model, take his numbers, and put everything out there in the open. His assumptions are that the mortgage interest rate is 3.75%. He shows that you have a monthly PMI payment of $172.77, property tax monthly at $94.17, county tax, the mortgage payment, etc. Now, I put in the $1,000 a month for bills, gas, and food, and he put in there the possibility. Now, this is where I think velocity banking has a positive thing to look at. And this isn't necessarily velocity banking. This is more Denzel's idea. I think Denzel has something good on this. He says, if you have the possibility, talk with your bank and get them to approve the ability for you to, instead of paying monthly into your escrow account for your PMI, for your property taxes, your county taxes, see if you can get those separated where you can pay those every 6 months or every year, depending on when yours are charged in your city or county. If you're able to break those up and make lump sum payments when they're due, that allows you, in the process of making payments on the house, to actually make a larger payment toward the house. Now, it doesn't make a huge difference, but it does make a difference. So that's where Denzel, I think, had something good going on for him, is try to break up your principal, interest, taxes, and insurance payment and try to make it just a principal and interest payment and pay your taxes and insurance separately. Now, Denzel, in his video, he said that it wouldn't matter what interest your line of credit would be at. He also gave some other assumptions. He assumed a line of credit of $20,000. He said that he would not borrow more than 66% of that line of credit. Now, I can tell you, the whole idea of velocity banking, for those that this is the first time you've heard of it, let me go and describe it. Essentially, velocity banking is where you get a line of credit, you borrow against it in a big lump sum, and you pay that big lump sum against your mortgage. Now, that's not it. You then take your paycheck, your normal paycheck, and you put that onto the line of credit. You direct deposit your paycheck straight into your line of credit every time you get paid. You pay all of your bills, your normal bills, through your line of credit, and you try to keep your bills as low as possible. In this method, what happens invariably is you will pay down what you owe in the line of credit over a few months. Typically, the ones that I've read, the ones that I've seen, the ones I've listened to, all preach about 6 months worth. If you can borrow just enough so that you can have it paid off every 6 months, then you'll pay off your mortgage fast. Now, that's the general idea. It's a lot to set it up, but once it's set up, it shouldn't be too terribly difficult. It's a lifestyle change, so you kind of have to get used to it if that's the way you decide to go. Now, my method for paying off my mortgage faster is very similar. But instead of taking a line of credit where I borrow to do a big lump sum payment toward the mortgage, instead what I do is I set up all of my bills to be paid automatically through my checking account, through bill pay. Now, my bank does it for free. And I've had multiple banks that I've been with, and every bank I've been with has done it for free. There are some banks, however, that will charge you to do bill pay. So you have to look at your bank or your credit union to see what they're going to do for you. So the way that I do it, the way that I suggest you do it, is you build up an emergency fund of $1,000,
$2,000, $3,000, whatever it is that makes you feel comfortable. And essentially, you build up that fund, and anything over the top of that fund at every paycheck. So if I get paid on Friday, anything I have left in my bank account at that time, if I subtract my emergency fund, let's say my emergency fund, for numbers, let's say my emergency fund was $3,000, and when I got paid, I had $3,500 in my bank account. Well, on the day that I get paid, I will pay that extra $500 I have left in my bank account above my emergency fund, and I will put that toward the principal on my mortgage. Then when the money comes in from my paycheck, I take that money and I apply it toward my bills. I apply it toward food, gas, the things that are normal, the things that you would spend your money on, diapers, whatever it is that you spend your money on. Trying to keep my bills low, of course, the same thing. And then when the next paycheck comes, whatever I've left in there, and maybe it's $3,800 this time, I take the $800 and I put it toward the mortgage. I put it toward the principal. It is the same principle as velocity banking. The only difference is I'm not borrowing from a line of credit to do it. Now, in Denzel's video, he talks about it doesn't matter what interest rate you use. And he gave the example, other people have given the example of 20% or 21%. If you're going to do the velocity banking, you want to keep that interest rate, of course, as low as possible. In my mathematical model, and I'll show it to you right now. In my mathematical model on Excel, I have all the variables that Denzel gave. And the only time that I have found that his model of velocity banking outdid my model of just paying extra toward the principal was when the velocity banking was, when the line of credit was charging less interest than the current mortgage. So in his case, with 3.75% being the percentage on the mortgage, if the line of credit is down, it has to be lower than that. So what I saw, I made the computer do the thinking for me, at 3.68%, that's finally when the line of credit or debt weapon for velocity banking is break even with me just paying the mortgage on my own instead of borrowing from somebody else and making payments to them. So what I have found is there's no point in doing it the velocity banking way if you're disciplined. But if you're doing it the velocity banking way, you also have to be disciplined, because what happens is you get this line of credit that you build up, and now you have money that you can pull from that maybe you didn't feel like you had that before. And so maybe you have a little bit more liberty in pulling from your line of credit because you see that limit is higher. So what I can see easily happening is people that have less discipline pulling from that line of credit and actually raising it up too high. Now, one of the benefits to velocity banking, and Denzel, this is one of the huge benefits that I see, and all the people that are watching, is that with a line of credit, if you're constantly borrowing from it, paying down the mortgage, and then paying down the line of credit, consistently paying on time because you're paying with every paycheck that you get, your credit score, your FICO credit score will go up. Under my method, your credit score will not go up any more than it normally would have. Now that comes from two different points of view. In my point of view, I don't like to have debt. I like to pay off my properties as soon as possible and have as many properties paid off as possible. So now I have borrowed, I will borrow money occasionally, and that's usually to buy a property if I'm going to buy one, but then I try to pay off as soon as possible. If you're borrowing money and you're consistently paying it off, you will increase your credit score. But if you're buying property outright cash, you don't need a credit score. It is faster and you pay much less interest if you just pay straight out of your checking account the extra that's left over. Now, when it comes to amortized versus simple interest, anyone that teaches velocity banking, anyone that I've seen so far, and I've seen multiple videos on people teaching this method, every single one of them has brought up the fact have brought up the idea of simple interest versus amortized interest. Amortization, let me explain what amortization is. Amortization is just taking up how much you owe and splitting it up over a number of periods. So if it's a 30-year loan, you're breaking up that mortgage payment in 30-year payments, 360 payments. So that's 360 monthly payments. That is amortization. Interest is not amortized. Interest is compounded. And that's where a lot of people get it wrong. Now, up here in the corner, I'm going to post a link to my video where I talk about amortized versus simple interest. Let me just break it down real quick, or you can watch that video. Simple interest is taking an interest rate and applying that toward a principal balance. Whatever the number comes up, that's how much you pay. Done, end of story. So for instance, where a lot of people get into this problem in misunderstanding is they'll say, for instance, I have a $100,000 mortgage. And if I have an annual percentage rate of 7%, they'll look at that and say, okay, the first year I'm charged $7,000. That's 7% on $100,000. The second year, let's say I pay $10,000 off. The second year, I'm going to pay 7% on the $90,000. The third year, 7% on the $80,000. The fourth year, 7% on the $70,000, and so on and so forth. And the people that are teaching velocity banking, they take a look at that and they say, okay, if you add up all this interest, let's say over the period of 10 years or the normal 30-year loan, you're going to pay about 100 to 150% of what you borrowed. So if I borrowed $100,000, by the end of 30 years, I probably will have paid about $250,000 for that house. $100,000 for the original that I borrowed and $150,000 on interest. And then when they look at that, they say, look at how much interest you have. That's amortized interest. That's terrible. The reality is that's compounded interest. There's an annual percentage rate. That 7% is not how much you'll pay over time. That's how much you pay in 1 year. And that's when people start bringing up, well, with your line of credit, if you pay off your mortgage faster, look at how little interest you pay compared to how much you would pay if you over 30 years. It's apples to oranges. It really is. That simple interest idea, that would be as if I went to you and said, I will lend you $100,000 at 150% interest. I'm going to get 150% interest, but you'll have the $100,000 you need to pay this person. And then over 30 years, you pay me $250,000, or over 5 years, you pay me $250,000, or over 1 year, you pay me $250,000. That's simple interest. The compound interest is whatever you owe at the end of that period, whether it's compounded daily, compounded weekly, monthly, or yearly, annually, whatever is still owing at the end of that period, the average balance, that is charged, that percentage rate that you agreed on with your lender. So that is compound interest. So of course, if it's compounded every month, every year, they're going to take how much you are supposed to be charged for that month or for that year in percentage rate and keep charging you the interest on that. So if you were to compound, if anybody that pays compound interest, that is much worse than simple interest. Much, much worse. However, there is not a single lender that I know of, not a single lender that I know of, that will charge you simple interest. Where they'll say, okay, I will lend you $100,000. In order to pay off the $100,000, you have to pay me $250,000 back. Not a single lender do I know that will do that. Mainly because they're not going to charge you 150% interest. It's going to look terrible on paper. And if they said, I'm going to charge you 7% simple interest on $100,000, then over 30 years, you only have to pay them $107,000. Period. End of story. You want to pay them off in a year, you want to pay them off in 30 years, it's all the same. So that's the difference between simple and amortized interest. So Denzel, that's to you, that's to everybody who is watching. Denzel, thank you for giving me the opportunity to take a look at your video. I'm attaching my Excel spreadsheet so you can see it. There are some things that were unknowns. For instance, the income of the person. I have found that the closer the income is to the amount that is paid every month, the worse velocity banking is. The better it is to use my method. The more somebody makes each month above and beyond what their mortgage payment is and bills, the better off velocity looks. So if I'm making $20,000 a month and my bills are only $2,000, then velocity bank is really good because you can pull out a lot and pay it off real quick. If you're making $4,000 a month and your bills are $3,900 a month, so you only have $100 to pay with, it doesn't really work that great. Now here's a caveat to that. The idea of velocity banking is to borrow enough that you can pay it off in 6 months. So if I only could afford $100 a month extra, velocity banking would teach you to borrow only about $600 to put it toward principal and then pay that down. That's how I've seen it on the people who have taught velocity banking. So while I think velocity banking, if that's the way you are using to pay off your mortgage, more power to you. I think anyone who's paying off their mortgage quickly is doing a phenomenal thing. There just is a faster way. There is a cheaper way. And velocity banking versus my method of banking, it's almost the same as far as speed. Almost the same. As far as savings, My way is faster. My way saves you more money. Velocity banking saves you a ton of money if you did nothing else. But my way is faster. And if you have any questions, please ask down below. If you like my video, please give it a thumbs up. If you don't like my video, all I ask is go ahead and give me a comment why you didn't like my video and hit that down button twice. And then hit subscribe. Thanks everybody. Until next time.